$5,183. That's where gold is trading right now today, March 11, 2026, as you're watching this video. And you know what's wild about that number? It's actually down from where it was just 48 hours ago. And here's the thing nobody in the mainstream financial media wants to talk about. The reason it dipped has almost nothing to do with the fundamentals of gold. It was a dollar blip, a technical reaction. And while retail investors panicked or shrugged, China's central bank just quietly kept buying. Again, for the 16th consecutive month in a row. Now I need you to hold that thought. 16 months. I'm going to come back to that number and show you exactly what it means for where gold is going next. But first, I need to tell you about a paradox happening in real time that, once you see it, you cannot unsee it. The same crisis that's pushing gold down right now is simultaneously creating the strongest structural argument for why gold is going much higher. And by the end of this video, you'll understand the mechanism behind that. Not as theory, not as speculation, but as documented market behavior backed by data you can verify yourself. So let me give you the full picture of what just happened this week, because context is everything here. On Monday, March 9th, gold fell 1.5% to $5,091.62 per ounce. Reuters reported that headline. CNBC's title was, quote, "Gold slips on stronger dollar, higher rate expectations." And on its face, that's true. The dollar spiked. Gold, which is priced in dollars, got more expensive for foreign buyers. Demand softened. Price dropped. That's the normal mechanical relationship. But what caused the dollar spike? This is where it gets interesting. The U.S.-Israel military operation against Iran entered its second week. Israeli forces had struck targets in central Iran and Beirut, and a senior Iranian Revolutionary Guard official confirmed what energy markets had feared most. The Strait of Hormuz had been closed. That's the narrow waterway through which roughly 1/5 of the world's entire oil supply travels every single day. And when that channel got choked off, crude oil jumped past $110, $115 a barrel. Inflation fears exploded overnight, and the Federal Reserve, which had been slowly creeping toward rate cuts, suddenly looked boxed in. If inflation reaccelerates, they can't cut. And the market knows gold loves low rates. It's a non-yielding asset, so when rates stay high, gold's opportunity cost goes up. So there it is. Strait of Hormuz closed. Oil surges. Dollar surges. Gold dips. Logical, mechanically. But here's the paradox. The exact same geopolitical crisis creating that short-term dollar move, war, instability, a potential oil shock, is the same reason the People's Bank of China has been buying gold without stopping for 16 straight months. Because when the world gets more fragile, when dollar dominance gets questioned, when a shooting war can shut off 1/5 of global oil in a single morning, that's when central banks don't want to be holding pieces of paper that say, "I promise" on them. They want the metal. Now, before I go further, let me establish something for anyone coming to this channel for the first time. What I do here isn't opinion, it's data interpretation. Every number I give you today has a source you can look up. The PBOC data comes from China's State Administration of Foreign Exchanges. The COMEX inventory data comes directly from CME Group's public warehouse reports. The central bank buying figures come from the World Gold Council's quarterly demand analysis, released January 29th of this year. I'm not asking you to trust me, I'm showing you the receipts. And speaking of receipts, here's one that stopped me cold when I dug into it this week. According to the World Gold Council's full year 2025 demand report, central banks globally purchased 863 tons of gold in 2025. That sounds like a lot. But here's the context you need. That's the 4th consecutive year above the historical average. In 2022, central banks bought 1,082 tons, the highest annual total ever recorded. 2023 was 1,037 tons. 2024 was over 1,000 tons. And then in 2025, even with gold prices hitting record after record, the central banks still collectively bought 863 tons. Not because they slowed down, but because the gold was getting expensive to buy, and they were being strategic about timing. And here's what the survey data says underneath that. The World Gold Council's 2025 Central Bank Survey, which had 73 respondents, the highest participation rate since the survey began 8 years ago, found that 95% of central banks expected their peers to increase gold reserves in the year ahead. 95%. That's not a trend, that's consensus. Quick message for those who aren't subscribed yet. My analytics show about 3 out of 4 people watching this aren't subscribed. If this kind of evidence-based breakdown is cutting through the noise for you, hit subscribe right now. That's how I track who the committed community is. It helps me know what to cover next, and it helps the algorithm show this content to more people who genuinely need to see it. All right, back to the story. Let's talk specifically about China, because this is the heart of today's title, the PBOC buying frenzy. And frenzy is my word for it, but let me give you the numbers and you tell me if a different word fits better. According to data released Saturday, March 7th by Bloomberg and confirmed by Kitco and Reuters, the People's Bank of China increased its gold holdings by 30,000 troy ounces in February 2026. That's the 16th consecutive monthly purchase. Total holdings now stand at 74.22 million fine troy ounces. That's 2,308 tons. Gold now makes up 9.6% of China's total reserve assets. And here's the number that jumped out at me from the World Gold Council's China Update published in February. China's gold ETFs, just the ETFs, added the equivalent of 38 tons in January 2026 alone, in 1 month. That was the strongest start to a year for Chinese gold ETFs ever recorded. Assets under management hit all-time highs. And at the same time, withdrawals from the Shanghai Gold Exchange, that's physical metal leaving the vaults, totaled 126 tons in January. 1 month. Physical gold flowing out into the hands of institutions, jewelers, and retail buyers. Now stick with me here because this next part is where it gets genuinely alarming. The reported value of China's gold reserves, also released Saturday, rose to $387.59 billion at end of February, up from $369.58 billion in January. That $18 billion increase in 1 month, and importantly, as the analysis from goldinvest.de pointed out this week, that jump in value can't be explained purely by the 30,000-ounce volume increase. The price of gold itself went up, making those existing holdings more valuable. China's gold pile is appreciating at a pace that is compounding faster than almost any other asset class on the planet right now. But here's what's been whispered in precious metal circles for years. And I want to be careful here to say this is discussed widely by reputable analysts, not fringe theory. The officially reported PBOC figures may represent a floor, not a ceiling, of actual Chinese gold holdings. The Chinese government has historically disclosed gold accumulation with significant lags. Analysts, including those at the World Gold Council, have pointed to independent estimates suggesting actual holdings could be materially higher. We can't confirm that. But even if you take the official numbers at face value, 2,308 tons and rising for 16 straight months, the strategic intent is unmistakable. China wants gold. China keeps buying gold. And China is not alone. Let me bring in the bigger picture here, because China is actually the smallest buyer in some respects when you look at the full roster of central banks moving into gold right now. Poland's National Bank was the largest single buyer in 2025, adding 102 tons over the year. Their holdings are now at 550 tons, which is 28% of total reserves. And in January 2026, Governor Adam Glipinski announced he wants to push that higher, to 700 tons. His exact reasoning? National security. Kazakhstan had its highest annual buying on record in 2025, purchasing 57 tons, more than they'd ever accumulated in a single year going back to 1993. Brazil re-entered the gold market after a 4-year absence, buying 43 tons in just 3 months, September through November. And there's a long tail of smaller buyers, Uzbekistan, Czech Republic, Indonesia, all adding to reserves month after month. According to the World Bank's October 2025 Commodity Markets Outlook, central banks' share of total gold demand rose to nearly 25% in 2024. That's double the 12% share they represented in the 2015-2019 period. These institutions, whose entire job is to hold the most boring, reliable, stable assets possible, have doubled their appetite for gold. Now let me ask you something. When the people who manage the reserves of sovereign nations, people with access to every economic model, every geopolitical intelligence brief, every financial data set in the world, when they are collectively pouring into gold at twice the historical rate, what do you think they know that isn't being said on CNBC? Now here's where it gets interesting. Because all of that central bank buying is happening in the paper and allocated metal world. But there's a parallel story happening in the physical market that's even more revealing. Let me walk you through what's been happening at COMEX, the commodity exchange, which is the world's largest gold and silver futures market, based in New York under the CME Group umbrella. For decades, COMEX worked on a simple premise. Almost nobody actually wanted physical gold. You'd trade futures contracts, promises to deliver gold at a set price and date, and then 99% of the time, before the contract expired, you just cash it out or roll it to the next month. Physical delivery was a tiny fraction, typically under 1% of open interest. The market was a paper game. The gold in the vaults was largely just collateral. That changed dramatically in late 2024, and by 2025, it had transformed entirely. According to detailed COMEX delivery analysis published in early January 2026, every single contract month in 2025 set delivery records. Every one. And the delivery rate, the percentage of contracts that converted to actual physical gold, climbed to nearly 7% of open interest. That doesn't sound massive, but understand, 7% is nearly 7 times the historical baseline that existed for decades. The market behavior has fundamentally shifted. By December 2025, COMEX processed 37,003 contracts in a single month, equivalent to 115.1 tons of physical gold, or 3.7 million ounces. People were taking delivery. They weren't rolling. They weren't cashing out. They wanted the metal in hand. And while people were pulling gold out of COMEX, something else happened that is the smoking gun of this whole story. In early 2025, when tariff fears drove a transatlantic arbitrage frenzy, COMEX warehouses surged to an all-time high of 43.3 million ounces, a 153% jump in 4 months, with Swiss refiners reportedly flying gold bars to New York daily just to restock. That was the peak. Since then, the registered inventory, that's the specific metal sitting in vaults with actual warrants attached, ready for immediate delivery, fell from an estimated 13.5 million ounces at the March 2025 peak to around 10 million ounces by year-end. A 25% decline in deliverable supply, even as prices surged to record highs. Think about what that means. The price is at the highest level in history. You'd expect that to attract more gold into the exchange, more registered inventory, because the incentive to sell is enormous. Instead, it shrank, which means the people who have the gold are choosing not to deliver it to the exchange at any price near current levels. There's a phrase for what happens in markets when sellers won't sell. It's called a bid without offer, and it's the precursor to a price dislocation. Now let me bring silver into this briefly because the silver story in early 2026 is even more extreme, and it's directly connected to the gold market dynamics. In January 2026, which is historically a quiet minor delivery month for silver, COMEX processed somewhere between 33 to 40 million ounces of silver deliveries in just the first 2 weeks. Compare that to January 2025 and prior years, where typical January silver deliveries were 1 to 5 million ounces. We're talking a 7 to 10 times increase in a traditionally dead month for deliveries. A detailed analysis from early February 2026 noted that COMEX registered silver inventory fell from around 240 million ounces back in April 2020 to approximately 86 million ounces by February of this year, a 64% decline over 6 years. And during January and February 2026, the exchange delivered the equivalent of 86.4% of its registered inventory in just 60 days. Read that again. 86.4% of what was theoretically available for delivery delivered in 2 months, while maintaining just enough buffer to avoid default. That's not a market functioning normally. That's a fire hose trying to fill a bathtub with a crack in the bottom. And here's the disconnect I want you to sit with for a moment. On Monday, March 9th, the spot price of silver dropped 3.1% to $81.90 an ounce. The paper price crashed. Meanwhile, physical delivery demand was running at 7 to 10 times historical norms. Paper said, less valuable. The physical market said, I want it now and I'm paying to take it. Which one is telling the truth? The paper market is, by design, a place where enormous leverage exists. For every ounce of physical gold or silver actually in a COMEX vault, there are many more paper claims on that ounce. When dollar conditions create short-term incentives to sell those paper claims, like a strengthening dollar making non-yielding metals less attractive, the price drops. But that selling is happening among people who never had physical metal to begin with. They're selling a financial instrument, not metal. The physical market, the buyers taking actual delivery, the central banks adding to vaults, the industrial users securing silver for solar panels and semiconductors, those buyers don't care about Monday's dollar move. They need the metal, and they are showing up every single month regardless of what the paper price does. The paper price and the physical reality have been telling 2 different stories for months, and historically when those stories diverge long enough and wide enough, one of them is forced to correct toward the other. The paper price always ultimately has to reflect physical reality, because you cannot deliver a promise. Now I want to walk you through a historical pattern, because what's happening right now is not new. It has played out before, 3 specific times in the modern era. The first was the late 1970s. By 1977, central bank sentiment toward gold was shifting. OPEC had demonstrated that oil was a geopolitical weapon. The dollar was weakening, inflation was running hot, and while the paper price of gold muddled along, physical demand from Middle Eastern oil states and Asian buyers was quietly pulling metal out of Western vaults. By 1979 and 1980, gold had gone from around $200 an ounce to $850, a 325% move in roughly 3 years. The paper market caught up to the physical reality with a vengeance. The second was 2001 to 2011. September 11th, 2 wars, the dollar under sustained pressure. Central banks in emerging markets began quietly rebuilding gold reserves. The mainstream financial press barely covered it. Gold went from $255 an ounce to $1,920 over that decade, a 653% increase. The people who were paying attention to central bank reserve data in 2002 and 2003 were sitting on life-changing gains by 2011. The third, and the one closest to what we're seeing now, was 2018 to 2020. Russia dramatically increased gold holdings and shed U.S. treasuries. China began its first extended buying cycle. Central bank purchases globally hit records. And then in 2020, as a global crisis hit, gold surged from $1,200 to $2,000. People who read the central bank data knew the structural support was there. When the catalyst hit, the move was violent and fast. We are now in a fourth cycle, and based on the data, I'd argue the structural setup is stronger than any of the previous three, because for the first time, virtually every major non-Western central bank is buying simultaneously. The physical market is experiencing delivery stress, and an active shooting war has introduced the kind of geopolitical instability that historically supercharges safe haven demand for years, not months. Let me show you the numbers on the current setup one more time, in plain terms. Gold hit an all-time high of $5,595.42 on January 29, 2026. It's now at approximately $5,183, about 7.4% below that peak. In a bull market cycle, these pullbacks are normal. The 1970s bull market had multiple 10 to 20% corrections before the final explosive move to the top. The 2008 to 2011 cycle had a gut-wrenching 25% drop in 2008 before the metal doubled from there. ANZ Bank's analysts have a 2026 price target of $5,800 per ounce. JP Morgan, not exactly a gold bug shop, has a year-end 2026 target of $6,300, according to financial content reporting from this week. Their reasoning? Persistent central bank demand is providing a structural price floor, and any dollar weakening will release the valve. Long-range models from Long Forecast and others project gold potentially reaching $7,100 to $7,848 by late 2026 if structural conditions hold. Now, I'm not going to tell you any specific price target is guaranteed. Nobody knows exactly where any market goes. But what I can tell you is this. The structural inputs, central bank buying, physical delivery demand, geopolitical fragmentation, dollar diversification, inflation risk from an oil shock, are all pointing in the same direction at the same time, and the institutions with the deepest pockets in the world are voting with their balance sheets. So what does all of this actually mean for you, practically? Let me be totally direct here. Nothing I say is financial advice. I'm not your financial advisor. I'm someone who reads the data and explains it. What you do with your money is your decision and yours alone. Always consult a qualified professional for anything specific to your situation. That said, here's what I think is worth understanding right now. First, today's dip to $5,183 is not a fundamental event. It's a mechanical dollar reaction to oil price shock and Fed rate cut repricing. The USA Gold analysis published on Tuesday, March 10th put it well. Monday's drop was a technical dollar reaction, not a fundamental shift. Gold bounced $124.70 in a single session on Tuesday. Asian central bank buyers and retail buyers who absorbed Monday's dip were already in profit less than 24 hours later. Second, the PBOC data released Saturday is significant not because 30,000 troy ounces is a large number in isolation, but because it represents the continuation of a strategic directive that has now run for 16 uninterrupted months. The Chinese government does not make accidental financial decisions. This is deliberate reserve diversification, and it is happening simultaneously with similar moves by Poland, Kazakhstan, Brazil, Czech Republic, and over a dozen other central banks. Third, the physical market is under stress that isn't visible in the spot price. COMEX delivery rates running at nearly 7 times historical norms, registered inventory declining despite record prices, Silver warehouses delivering the equivalent of 86% of registered supply in just 2 months. These are not normal market conditions. They are structural tightness that eventually forces a price reconciliation. Fourth, the Fed meeting on March 17 to 18 is worth watching. The market has already pushed back rate cut expectations to September or October, partly because of oil inflation risk from the Strait of Hormuz closure. If the CPI data that came out today, March 11th, is hotter than expected, the 2.4% year-over-year forecast, we could see another short-term headwind for gold. But analysts across the board, from Citi Index to Reuters-quoted market watchers, have said this is temporary. The flight to safety bid comes back. Fifth, watch the Shanghai Premium. Gold Invest noted specifically this week that gold is noticeably supported during Asian trading hours, meaning Eastern institutional buyers are consistently stepping in during their session to bid up the metal. That's physical demand from the world's largest gold-consuming nation acting as a structural bid every morning. Sixth, mine supply is not going to rescue the situation. The World Gold Council confirmed that total gold mine production for 2025 reached a new record of 3,672 tons, but total supply grew by only 1% for the year. Central banks alone bought 863 tons. Investment demand, jewelry, and technology consumed the rest. At current trajectory, demand is running well ahead of new supply. And seventh, this might be the most important one. If you are someone who has been watching gold, thinking about it, researching it, but waiting for a dip to get in, this is a dip. From $5,595 on January 29th to $5,183 today is a 7.4% pullback in a structural bull market with central banks buying for 16 straight months. Whether that's the exact bottom, nobody knows. But the context for this dip is not fundamental deterioration, it's a temporary dollar trade. Let me bring this full circle, because I want to leave you with something that I think cuts through all the noise. In 1971, when Nixon closed the gold window and ended Bretton Woods, the world's central banks spent the next decade trying to pretend gold didn't matter anymore. They sold it, leased it, talked it down. By 1999, the Bank of England was famously selling gold at $252 an ounce, near a generational low, in what became known as one of the worst financial decisions in modern banking history. They got rid of half their gold reserves, and they did it at the exact moment the structural case for gold was rebuilding. Today, the exact opposite is happening. Central banks that sold in 1999 are buying. Central banks that sat out the 2010s are buying. And the institutions that have never significantly held gold, emerging market banks from Southeast Asia to South America, are buying for the first time. The World Gold Council's 2025 survey found that 95% of central bank respondents expected their peers to increase gold reserves in the coming year. That survey had 73 participants, the highest in the history of the survey. This is not a fringe view among central bankers. This is consensus. And here's the thing about consensus. By the time it's consensus, the price has usually already moved. In 1999, the consensus was, gold is a relic. By 2011, it was $1,900. In 2015, the consensus was, gold is dead. By 2020, it was $2,000. In 2022, the consensus was, the Fed will destroy gold with rate hikes. It went from $1,800 to $5,595. The consensus now, among central bankers at least, the people who manage sovereign reserves for a living, is that gold is essential, that de-dollarization is real, that geopolitical risk is structural, not temporary, and that a world where a single war can close the Strait of Hormuz and reshape global inflation in 48 hours is a world where you want assets that cannot be frozen, cannot be sanctioned, and cannot be printed into oblivion. The dip to $5,183 today is the paper market catching a cold. The physical market and the central banks are still buying gold like it's on sale. If you've made it this far, I genuinely appreciate your time. Drop a comment and tell me this. Do you think the paper gold price and the physical market dynamics can continue to diverge? Or do you think we're approaching the moment of forced convergence? I read every single comment. The best conversations on this channel happen in the comments section, and your perspective genuinely shapes what I cover next. If today's breakdown gave you something useful, something you didn't get from the standard financial news cycle, hit the subscribe button. My next video is going to cover something that almost nobody is talking about yet, the growing premium between Shanghai gold prices and New York prices, what it means for the arbitrage trade, and why Swiss refiners airlifting gold across the Atlantic may be just the beginning of a supply chain story that reshapes global gold market infrastructure. That one drops in the next few days. You do not want to miss it.